For decades, managing physical assets has followed a predictable script. You notice a problem, usually by waiting for a leak or a visible failure. Then you send someone up a ladder with a clipboard, and you write a check to fix it. From an accounting perspective, that model classifies property inspection as a purely reactive, sunk operating expense. Money leaves the business to maintain the status quo, generating zero forward-looking financial return. It also introduces severe physical risk. In a single recent year, ladder falls resulted in 161 workplace deaths and 22,700 injuries. For U.S. businesses, that specific liability translates to an annual cost of $24 billion. By relying on a human being to climb a structure just to figure out what is actually broken, you assume maximum physical liability while gaining zero financial leverage. Property operators are solving this by moving to high-fidelity aerial documentation. Instead of ladders, they deploy FAA Part 107 certified drone operations. This quadrant chart maps property maintenance strategies. Deploying high-fidelity aerial systems creates a structured, verifiable baseline. It shifts maintenance out of the bottom left reactive zone, moving firmly into the top right as a proactive financial asset, replacing guesswork with time-stamped visual proof. This creates an interesting decision point for property managers. You have to weigh whether deploying capital upfront before the end of the year is worth the immediate tax deductions and the total elimination of initial inspection liability. We are going to look at how this works mechanically using IRS Publication 535 and current liability data, though you will naturally need to consult your own CPA for final tax execution. The true value of a drone inspection is rarely the flight itself. The value is taking raw physical risk and converting it into a documented financial strategy. To control the financial timing of this required maintenance, commercial operators use prepaid service agreements. The mechanism here is IRS Regulation Section 1.263A4F, commonly known as the 12-month rule. It allows businesses to deduct prepaid service contracts that last 12 months or less in the year they are paid. This simple bar chart compares the cash flow. If you lock in a $2,000 retainer before December 31st for your upcoming 2026 drone inspections, you are positioned to see a tax savings of roughly $440 if you sit in a standard 22% bracket. Because the entire expense is deducted in the current tax year, it immediately reduces your current taxable income. That deduction effectively subsidizes the cost of work that won't even be performed until next year. The trade-off is liquidity. You must be willing to lock up operational cash flow today for a service you will not receive for several months. For businesses sitting on end-of-year liquidity, prepaying an aerial retainer turns an inevitable future maintenance cost into a guaranteed immediate tax advantage. The IRS frequently challenges property owners on a very specific distinction. Was the work you did a deductible repair, or was it a depreciable capital improvement? This split-screen comparison shows exactly why property owners lose those audits. A generic, subjective written condition report on the left simply cannot stand up to scrutiny the way high-resolution, time-stamped aerial mapping can on the right. Capturing the exact state of a commercial roof with objective imagery creates a definitive before and after record. When you have verifiable data proving the extent of the degradation, defending a repair classification becomes straightforward. The operational requirement here is data management. Generating high-fidelity imagery means you need structured digital storage. If your team mismanages the files or loses the reports, you lose your audit defense. But when managed correctly, replacing human estimates with objective visual proof acts as the ultimate shield during cost segregation or depreciation audits. Beyond the tax code, aerial documentation solves a severe operational problem, keeping your team firmly on the ground during the initial evaluation. While ladders cost the U.S. economy $24 billion annually in injuries, FAA Part 107 certified commercial drone operations have logged zero major incidents in 8 years. This exact same data pipeline also changes how you deal with insurers. By supplying adjusters with comprehensive, time-stamped visual evidence immediately after a storm, commercial properties routinely see their claims approved up to 50% faster. Drones are built for discovery, not repair. A drone will map a moisture intrusion perfectly, but you will still need to send a human up to apply the patch. Also be aware of what a perfect baseline means. Documenting your property flawlessly creates a historical record which exposes you if you choose to ignore pre-existing deferred maintenance. Removing humans from the initial discovery phase completely isolates your business from physical liability while dramatically accelerating your recovery time after a major weather event. This decision tree maps out how to apply these strategies to your specific situation. If you manage a commercial portfolio, oversee an HOA, or are simply looking to reduce current year taxable income before December 31st, an annual inspection retainer is highly effective. If you are a single-family homeowner without a dedicated business itemization, or you don't have immediate storm damage to claim, prepaying a retainer won't offer you the same financial leverage. You are better off booking reactively. If you do move forward, you must require CPA-ready file formats and strict Part 107 compliance from your provider. The tax and insurance benefits only hold up if the underlying data is unimpeachable. Locking in maintenance before year-end converts an unavoidable physical expense into calculated financial leverage. Every dollar prepaid before December 31st actively reduces the tax bill you are facing right now.